Welcome to the deep dive. Today, we're plunging headfirst into the crypto world. It's high stakes, moving super fast as always.
Definitely.
We're focusing on what feels like a real turning point. You've got big macro shifts, regulation heating up, and some, well, surprising new investment products hitting the scene.
That's right. And our mission today, it's pretty straightforward.
Yeah.
We're taking this dense market analysis report, the one from today, September 19th, 2025, and we're going to boil it down for you.
Get to the core insight.
Exactly. Help you figure out what's just short-term noise versus the fundamental signals that are really shaping where things go long-term.
And there's a lot of noise right now. The report really flags two big things driving it. That U.S. Federal Reserve rate decision, which just landed.
Yep, very recent.
And at the same time, some potentially groundbreaking regulatory moves coming out of Washington.
Mm-hmm. And that sets up the central tension, for anyone watching this space. Are we just seeing a little dip, a classic sell the news kind of thing?
Where people take profits.
Yeah, totally normal. Or is this new activity, the institutional interest, the clear regulations, is that actually laying the foundation for something much bigger? Sustained growth over the next, say, few quarters.
That's the million-dollar question, or maybe billion-dollar question these days.
We're going to try and pull apart the drivers for both scenarios today.
Okay, let's do it. Let's unpack this, starting with, well, the elephant in the room, the Fed.
Right.
They cut interest rates first time in 2025. This came out of the FOMC meeting that just wrapped up, September 17th?
That's right, just a couple of days ago.
And the report we're using gave this the highest possible importance rating. It's clearly a big deal.
Oh, absolutely warranted. Because, look, it's more than just one cut. This signals the official end of the tightening cycle we've been in.
Okay.
And monetary policy, it basically directs where money flows globally. History shows when rates drop, holding safe stuff like government bonds, well, it gets less attractive. They pay less interest.
So the money looks for somewhere else to go.
Exactly. It encourages capital to move into things with potentially higher yields, maybe higher risk, and crypto. It's pretty much the ultimate risk asset, so it's often a primary destination for that flow.
Okay, so positive expectation, right? Fed cuts rates, money flows to crypto. But the market's immediate reaction, it was kind of negative.
Yeah, surprisingly so.
The report mentions more volatility, a slight dip right after the announcement. We saw Bitcoin hovering around, $116,074, down just under 1%.
Yep, negative 0.75%.
And Ethereum at $4,522, down a bit more, like 1.0%.
It's that classic crypto irony, isn't it?
Yeah.
The moment everyone's waiting for, the certainty arrives.
And people sell.
And people sell. Short-term profit-taking. Traders had likely already bought in anticipating the cut. There was a run-up before the news.
Oh.
So when the official word dropped, boom, they locked in profits. That's pretty much the definition of sell the news.
But hang on. Those prices, Bitcoin at 116K, that's already huge. If the good news was priced in, why the rush to sell?
Does that hint at some underlying nervousness? Like maybe the cut wasn't big enough to keep that momentum going?
That's a really critical question. And yeah, it probably suggests a couple of things. One, the anticipation was, let's say, very aggressive.
Okay.
And two, maybe institutional players are still pretty sensitive to any whiff of volatility. But the report's quick to point out this isn't hitting everything equally.
Right, it's not across the board. The volatility is more in the majors.
Exactly. The report actually identifies some specific altcoin sectors that look poised to benefit first from any new liquidity.
Interesting. Which ones?
Sectors that tend to react quickly to fresh retail money, so DeFi, decentralized finance.
Okay.
Some of the high beta Memecoins, DOGE was mentioned specifically.
DOGE, okay.
And certain layer one altcoins like Solana, SOL, and Avalanche, AVAX. These are often the assets that really take off when liquidity picks up because they offer potentially higher returns than just holding BTC or ETH. So Fed creates the macro waves, maybe some short-term chaos.
Yeah.
But underneath that, regulation is starting to build a more solid foundation maybe for the longer term.
That's exactly the picture the report paints. Regulation is really framed as the key long-term factor for attracting serious institutional money.
Okay, let's pivot to that then. Regulation. The report calls it the key long-term factor, and it sounds like there's a real effort now between the CFTC and the SEC to, harmonize things? Get on the same page?
Yeah, harmonize is a good word, a coordinated effort. And this move towards a clear, unified framework, that's probably the single biggest green light for institutional funds.
Why is that so important for them?
Well, think about it. Big institutions, banks, asset managers, they don't necessarily hate rules. What they hate is uncertainty.
Okay. Knowing the rules of the game?
Precisely. Clear, predictable rules. That removes the massive legal headaches, the compliance nightmares that have basically kept them on the sidelines for years.
And there are actual dates to watch here. The report mentions a regulatory roundtable on September 29th.
A key date.
And also, the White House is apparently looking at new candidates for the CFTC chair position. Why should, someone listening care about who leads the CFTC?
Because that role is critical. Whoever chairs the CFTC sets the tone, influences how crypto commodities are defined, which new products get approved, like the next wave of altcoin ETFs.
Right, so it impacts what products become available.
Absolutely. This is active leadership shaping the future landscape right now.
Yeah.
It tells you the regulatory push is gaining speed, not stalling out.
And speaking of products, we don't actually have to guess about this stuff anymore, do we? We've seen a major test case already.
We have indeed.
The report highlights the successful launch of two pretty interesting new ETFs, one for XRP and one for DOGE.
Yeah, and the initial reaction was pretty staggering, actually. The report verified huge day one volume. What was it? $54.7 million traded across those two funds combined on the very first day.
Wow, $54.7 million. That's serious institutional volume for altcoins, not just Bitcoin or Ethereum.
It really is.
It's also a bit surprising, maybe. XRP and DOGE. They've had their share of, let's say, volatility and controversy in the past. Why them first? What made them okay for an ETF launch?
That's a great point, and it probably says a lot about, well, established ecosystems maybe. And community size.
Okay.
Both have really liquid, long-standing markets. And maybe, crucially, the firms sponsoring these ETFs, they clearly did the heavy lifting with regulators.
Yeah.
Found a way to classify these assets that worked under the current rules.
So they tick the right boxes?
Seems like it. And that success, that $54 million day one, it shows there's real demand from traditional investors for compliant ways to get exposure beyond just BTC and ETH. They want diversification.
And that demand creates its own momentum, right?
Exactly. It creates localized price pressure. You see XRP and DOGE potentially decoupling, moving up, even while the broader market is still digesting the Fed news. It's powerful.
Yeah, absolutely. That success, especially with those specific alts, feels like a signal. Institutional money isn't just waiting for Bitcoin products anymore. They want diversification, and they're ready now.
So we need to look beyond the immediate headlines. The Fed noise, the initial ETF pop. We need to focus on the actual architecture being built, what's happening structurally over the next few weeks and months.
The underlying foundations.
Right. And those signals look incredibly strong. The report digs into this.
I saw that, particularly around DeFi and real-world assets, RWAs. Can you just quickly remind us what RWAs are?
Sure. Think of RWAs as the bridge between traditional finance and the crypto world.
Okay.
It's taking assets like, say, real estate or corporate debt or even yields from U.S. treasuries and putting them on the blockchain, tokenizing them.
So traditional investors get familiar assets, but in this new crypto framework.
Exactly. And institutional interest here is apparently surging because it offers something tangible, yield backed by real-world stuff, not just crypto speculation.
Got it. And the fuel for all this, the liquidity layer, but the projection in the report is just astronomical. Total stablecoin supply hitting $1 trillion.
Yeah, $1 trillion. Stablecoins, basically digital dollars, they're the essential lubricant for the whole ecosystem, especially for trading these RWAs.
Makes sense. You need a lot of reliable digital cash to trade tokenized houses or bonds.
You really do. And that $1 trillion number, it's so significant that even central banks are watching closely. The European Central Bank, the ECB, was mentioned.
What are they saying?
They've emphasized wanting stablecoins to be compatible with their own potential central bank digital currencies, CBDCs, specifically to maintain financial stability as this stuff goes mainstream.
Wow. Okay, so even the ECB sees this as inevitable, needing to integrate it.
That level of attention really validates the long-term importance of stablecoins as that base layer.
And it's not just financial plumbing, right? We're seeing tech advancements too. The report flagged a couple of big ones.
Yeah, key infrastructure upgrades.
First, MetaMask, huge crypto wallet provider, confirmed they will eventually launch their own token, MASES.
Which has been rumored for ages. Confirmation is big.
And second, Ethereum developers set a date for a major network upgrade. The goal is to increase Layer 2 scalability by 8 times.
8 times?
Yeah.
Let's just pause on that. 8 times faster Layer 2s on Ethereum. That means using applications built on top becomes dramatically cheaper and faster for everyone.
So games, DeFi, payments, everything gets better.
Everything. If you're building anything on Ethereum's ecosystem, that kind of scalability boost, it's the difference between being a niche product and having a shot at real mass adoption.
Right. It lets the network handle way more users without gas fees going crazy.
Exactly. It absorbs growth. So you connect these dots.
Okay, let's try. We've got clearer regulations coming.
Yep.
Institutional demand for real-world yields via RWAs.
Check.
A potential $1 trillion in stablecoin liquidity to fuel it all.
The fuel, yeah.
And massive tech upgrades, making the core network vastly more usable.
Put it all together, and it paints a picture of really robust fundamental innovation and infrastructure build-out. That's happening regardless of the Fed's short-term moves. It strengthens the whole platform for sustained growth.
Okay, that makes sense. So lots of positive signals, but the market's still choppy right now.
Very dynamic, yeah.
Yeah.
Which means if you want to navigate it effectively, you need more than just a general bullish feeling. You need specific data points to track.
Actionable intel.
Precisely. The analysis highlights 3 essential metrics, 3 indices you really need to keep an eye on right now. This is where you, listening, can really apply this and maybe get ahead of the curve.
All right, let's get practical. Metric number 1.
Okay, number 1, the most direct one perhaps, ETF flows.
For the new XRP and DOGE ETFs.
Exactly. Why track them? Because they give you a precise daily pulse check on traditional investor demand for those specific assets.
So watching the net inflow versus outflow tells you.
It's like a crystal ball for their midterm price trends. That big day one was the splash, but sustained inflows. That's what proves the lasting impact and validates the demand.
Got it. Daily flows for XRP and DOGE ETFs.
Yeah.
Metric number 2.
Number 2 takes us back to macro. The U.S. Dollar Strength Index, the DXY.
Okay, why the dollar index?
Super important context. The DXY measures the dollar against other major world currencies. Now remember, the Fed cut rates. That policy easing typically weakens the dollar over time.
Right.
And a falling DXY, a weaker dollar, historically creates a favorable environment for non-fiat assets, risk assets, like Bitcoin.
Ah, the inverse relationship. Weaker dollar, stronger Bitcoin potential.
Generally, yes. So watch the DXY. If it keeps trending down, that's a tailwind for crypto, especially Bitcoin. It's a key leading indicator for global risk appetite.
Okay, DXY. And the third metric.
Number 3 brings us back inside the crypto market itself. Bitcoin dominance.
Right, the percentage of the total crypto market cap that's in Bitcoin. What's the current level?
Around 54.09% according to the report.
And why track this now, especially after the Fed news?
Because it tells you where capital's moving within the crypto space. Is money flowing into Bitcoin or out of it into altcoins?
How do we interpret the moves?
Okay, so if Bitcoin dominance starts increasing in the next week or so, that suggests investors are treating Bitcoin like the safer play within crypto. A flight to relative quality may be due to the volatility.
Okay, risk off within crypto.
Exactly. But if Bitcoin dominance starts decreasing, that's the signal that money is flowing more aggressively into altcoins, chasing those potentially higher returns we talked about.
The classic sign of a potential altcoin season.
That's the one. So, tracking BTC dominance tells you about the risk appetite within the crypto market itself. Super useful.
Okay, so ETF flows for specific alt demand, DXY for macro tailwinds, and BTC dominance for internal market rotation. That's a solid dashboard.
We think so. It helps cut through the noise. So to kind of wrap up the immediate outlook for you.
Yeah, what's the bottom line for the next day or two?
Expect more chop. Significant volatility, probably a bit more correction or just sideways trading for the next, say, 24 to 48 hours. The market needs time to digest the Fed news and those initial ETF figures.
Let the dust settle.
Let the dust settle. But after that digestion period, the report suggests a potential upward trend could start to form as the positive reality of easier money sinks in.
And watch out for specific coins.
Definitely. Keep a close eye on XRP and DOGE. You could see strong, localized surges there, driven specifically by those new ETF inflows, separate from the broader market trend.
Which brings us back to managing risk in all this. Again, not investment advice, but practical strategy.
Absolutely crucial right now. The report really hammers this. Be extremely cautious with leverage. High volatility means liquidation risk is way up.
Don't get wiped out by a sudden swing.
Please don't. And diversification is key.
Right.
Don't put all your eggs in one basket. Spread capital across different areas with strong narratives, maybe some layer one, some DeFi plays focused on those RWAs, and now potentially these ETF-backed assets like XRP and DOGE.
Makes sense. Spread the risk, capture different potential growth stories.
Exactly. Which leads us to maybe a final thought, a provocative question for you to mull over.
Okay, leave us with something to think about.
Given that huge initial success of the XRP and DOGE ETFs, the $54 million validated demand, and with more regulatory clarity seemingly on the way, maybe around that September 29th date,
Yeah.
the big question is, does launching these specific successful altcoin ETFs mean the market's finally ready to grow beyond just Bitcoin? Are we seeing real institutionally backed diversification finally take hold?
Or is Bitcoin still king?
Or will that historical pattern hold?
No.
Will Bitcoin's current dominance, that 54%, prove just too resilient? Will capital snap back to Bitcoin despite these new altcoin channels?
So diversification versus Bitcoin gravity.
That's the structural tension. And how that plays out will likely define whether we see a broad market rally lifting all boats or just a few targeted assets really surge through the rest of 2025.
Fascinating times. Lots to watch.
Never a dull moment in crypto.